A sponsor asks, if I want to raise capital all year, shouldn't the fund be open-end? This is syndication attorney Field Notes with Tilden Moschetti. Today's Field Note is about closed-end versus open-end private equity funds in a Regulation D private fund offering, and why asset liquidity controls the answer. The direct answer is this: your fund structure has to match your asset liquidity. Structure follows liquidity, not marketing. For an investment fund sponsor raising money through a private placement, closed-end usually fits assets that are hard to sell quickly. Development, heavy value-add real estate, distressed deals, assets where investors need to wait for the business plan to play out. Open-end can work for a more stable cash-flowing portfolio, but only if the fund can support NAV pricing, limited redemption rights, cash reserves, gates lockups, and ongoing document maintenance. NAV means net asset value. Plain English, it is the value of the fund's assets minus what the fund owes. In an open-end fund, NAV is not just an accounting exercise. It can set the price for new investors coming in and existing investors going out. The common mistake is treating open-end as a better label. A sponsor may think, I do not want to start a new syndication every time. I want one fund that keeps raising capital. I also want to tell investors there is a way to request liquidity. That sounds efficient, and sometimes it is. But the moment you give investors a redemption right, you have made a promise inside the fund documents. That promise has to match the assets. In a closed-end fund, investors come in during a defined raise. The fund closes, the sponsor buys or develops the assets. Capital comes back when the assets are sold, refinanced, or otherwise realized under the business plan. Investors may receive cash flow along the way, but they do not have a standing right to demand their capital back each quarter. That structure fits illiquid assets because it lets the manager wait. If the market is soft in year 3 of a 7-year hold, the fund can hold. It is not dealing with a wave of redemption requests at the same time. An open-end fund works differently. New investors may enter on a set schedule. Existing investors may request redemptions on a set schedule. Often that schedule is quarterly. The price for both entry and exit is based on NAV. That is why open-end is a commitment to continuous independent valuation. If NAV is too high, an exiting investor may get paid too much. That hurts the investors who stay. If NAV is too low, a new investor may buy in too cheaply, or an exiting investor may be underpaid. Either way, the price matters. This is why many open-end private funds use a third-party administrator or outside valuation process, not because it sounds fancy, because the sponsor should be able to show how the price was set. The other piece is redemption architecture. Redemption rights should not be loose. A fund may use a lockup, meaning investors cannot redeem for a set period. It may use redemption gates, meaning only a set amount of capital can leave during a period. It may use queues, so unpaid requests move forward over time. It may also include suspension rights for real stress events. But suspension is a contractual mechanic, not an inherent right. A manager does not automatically get to pause redemptions just because cash is tight. That right needs to be built into the fund documents before the issue shows up. Now make it practical. Imagine a Regulation D private fund that owns 5 apartment buildings. The buildings are decent assets. They produce income, but the fund keeps limited cash. Then in one quarter, investors representing 20% of the fund ask for redemption. If the fund is open-end and the documents are too generous, the sponsor may be forced to find cash fast. But apartment buildings do not turn into cash overnight. Selling one may take months. Selling one during a weak market may mean accepting a lower price. That is the liquidity mismatch. Investor redemption rights are liquid on paper. The real estate is illiquid in the real world. A closed-end fund avoids that specific pressure because the investor exit is tied to the asset strategy. The investors know they are waiting for the hold period and the eventual sale. An open-end fund can manage the pressure, but it has to be built for it. Maybe the fund has a long lockup. Maybe redemptions are capped at 10% of fund assets for a period. Maybe excess requests are prorated and queued. Maybe the fund keeps larger cash reserves. Maybe the NAV is set by an outside process. Those are not small details. In private markets, the fund structure is the liquidity. Now, a few assumptions not to make. Do not assume a private open-end real estate fund works like a mutual fund. A mutual fund may hold liquid securities and price every day. A private fund may own buildings, loans, or private companies. There may be no ready market for the interests. The only exit is the one the fund documents provide. Do not assume continuous fundraising is just a marketing change. A continuous offering means new investors may be reading your offering documents months or years after the first closing. If the facts change, the PPM may need updates. Interest rates may be different. The portfolio may be different. The leverage may be different. The redemption history may be different. The disclosure should match the fund as it exists when the new investor comes in. There is also maintenance work. A continuous private placement may involve Form D amendments, including annual updates. None of that is dramatic. But it is part of the operating rhythm when the offering stays open. So how should a sponsor think about the choice? Start with the assets. If the strategy is development, heavy renovation, distressed debt, or anything that needs several years before cash is available, closed-end is usually the cleaner fit. The structure tells investors the truth. Your money is committed until the strategy has time to work. If the strategy is stabilized, cash flowing, diversified, and able to carry reserves, then open-end may fit, but only if the sponsor is ready for real NAV work, redemption gates, lockups, suspension language, and ongoing administration. The final field note is simple. Closed-end versus open-end is not a branding choice. It is a liquidity promise. Closed-end says investor capital stays in until the assets create the exit. Open-end says investors may enter and request exit over time, but only through the rules the fund can actually support. The right question is not whether continuous capital sounds attractive. The right question is whether the assets can honor the promise printed on the label. Structure follows liquidity, not marketing.